Stagflation fears from 58% of fund managers could pressure TSX dividend holdings, so scan your TFSA for rate-sensitive names today. This is Modern Investing Techniques, episode 143. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. The S&P 500 closed at 7,708, up 0.2%. The NASDAQ Composite finished at 26,331, also up 0.2%. The TSX Composite ended at 36,402, up 0.1%. July FOMC minutes showed a marginally less hawkish tone, with 3 dissenters noted and references to AI rising from 6 in January to 26 in July. Bank of Canada and Fed decisions remain the key macro frame for rate-sensitive Canadian holdings this week. About 15 days ago, we picked AMD on post-earnings positioning in AI names, and it closed up 0.99%. Showing how sector rotation can override individual catalysts when volume lags. Stagflation positioning involves tilting toward companies with pricing power and resilient cash flows when growth slows and inflation stays elevated. Today's BofA survey shows 58% of fund managers still expect stagflation over the next 12 months, down only slightly from 69% in May. That keeps pressure on high-valuation growth names while supporting select dividend payers in energy and financials. Implement this by screening TSX names for payout ratios below 60% and 5-year dividend growth above 5%. Then cross-check sector rotation signals using volume above the 20-day average before adding exposure. This approach worked best in 2022, when energy and materials outperformed during the prior inflation spike. It carries the risk of underperformance if inflation cools faster than expected and growth reaccelerates. Always pair the screen with same-day volume confirmation to avoid false rebounds. Canadian investors can run the screen inside a TFSA to keep compounding tax-free, focusing first on names already showing free cash flow coverage of dividends above 1.2 times. The same BofA data also flagged that stagflation expectations have eased only modestly, so any hotter August CPI print could reinforce the defensive tilt. Imagine you sold 20 Delta cash-secured puts on a stock you actually want to own after a modest dip. Your order only gets filled 20% of the time, meaning you miss the chance to buy at a discount on 4 out of 5 occasions when the stock stays flat or rises. The mechanism here is probability. A 20 Delta put has roughly an 80% chance of expiring worthless, which suits pure yield chasing but defeats the goal of acquiring shares at a lower net cost. Professionals always check the 30 or 45 Delta strikes instead, because they raise the fill rate to around 55 to 65% while still collecting meaningful premium. Then compare the annualized yield against simply buying the shares outright. What most retail investors don't realize is that the higher Delta approach turns the put into a disciplined entry tool rather than a lottery ticket for income. The concrete misconception to avoid is treating all put-selling strategies as equivalent yield plays. Match the Delta to whether your real objective is ownership or just premium collection. In a TFSA, the higher Delta put also preserves contribution room because assignment simply moves cash into shares without triggering extra taxable events. This is a simulated trade for educational purposes only. No real money is involved. This is not financial advice. Today's practice investment is a midweek update with no new entry. We are monitoring SU.TO in the energy sector on a dividend growth entry strategy tied to a potential hike signal. The hold period remains fixed at 5 sessions from any future entry. Invalidation occurs if Suncor guidance shows no dividend increase in the next quarterly update. The catalyst is a potential dividend hike following recent earnings resilience in energy. Technical setup shows price action near the 50-day moving average, with volume required above the 20-day average for confirmation. Risk assessment calls for a stop loss at 8% below entry to cap loss on any oil price reversal. Target remains +3 to +6% on confirmed hike news within the hold window. Confidence sits at medium because the thesis aligns with dividend strength but lacks immediate volume confirmation. This setup demonstrates waiting for a specific catalyst confirmation before committing capital, avoiding premature entries in sectors with mixed historical alpha. Listeners learn to define invalidation clearly so the stop loss becomes a data-driven rule rather than an emotional exit. Canadian investors holding SU.TO inside an RRSP would also capture the full tax-deferred compounding if the hike materializes. Yesterday, we simulated a flash trade in MFC.TO on dividend strength entry and sector rotation into Canadian financials. The position entered at $61.24 on the Wednesday open and exited at $60.06 at the close. The result was a loss of 1.93%, or $19.27 on a $1,000 position. The dividend catalyst produced a quick reversal once broader rotation pressure hit, showing single-name exposure can lag even on positive fundamentals. Rule: always cross-check sector rotation signals before sizing earnings-driven entries. Portfolio performance shows 51 total simulated trades at a 55% win rate for cumulative profit and loss of $314.12. The matched window alpha versus NASDAQ stands at negative 1.69% across one rules-based trade. Average return per trade is 0.62%, with best trade plus 20.11% and worst trade negative 11.80%. The ERA 2 rules-based record began 2026-08-18, and every trade follows the fixed 5-session maximum hold or stop-loss exit. Polymarket shows only 8% odds of OpenAI hitting a $2.5 trillion valuation by year-end. This prediction market gives retail traders a real-time sentiment gauge that can inform position sizing on high-valuation AI names ahead of earnings or funding news. Use the free platform and filter for tech and crypto contracts with at least $500,000 in volume for reliable pricing. The 8% probability sits well below recent peaks, offering a contrarian signal for those tracking AI infrastructure exposure. Unusual Whales flagged a Moderna options contract that moved from 1 cent to $70. The platform surfaces large options trades with premium and percentage change data, so active traders can set alerts for unusual volume in names they follow. Access starts at the basic tier for $99 per month with real-time flow and contract details. The 700,000% gain on that single messenger RNA contract illustrates how flow data can flag extreme sentiment shifts before price moves fully reflect them. Moderna has delivered the second highest total return in the S&P 500 year to date, behind only SanDisk. The surge places messenger RNA ahead of most mega-cap names despite broader healthcare rotation pressures. Add messenger RNA to your watch list and wait for a 5% pullback before considering any new position. Uber, Verne, and Pony AI began offering self-driving rides in Zagreb, the first European city available through the Uber app. This marks the initial European deployment of the combined autonomous service and could serve as a template for further city rollouts. Hold existing Uber shares, but avoid adding until volume confirms above the 20-day average on any follow-through move. Anthropic reported preliminary second quarter revenue above $11.5 billion. The figure highlights how quickly frontier AI labs are monetizing even before public listings. Watch NBIS and CRDO in the ChatGPT portfolio holdings for correlated moves on any AI funding news. Rogers shows resilient cash flow and subscriber growth that may not yet be fully priced in after recent sector rotation. The company's wireless and cable segments continue to generate stable recurring revenue, even as macro uncertainty lingers. Place RCI.B on your TFSA review list and compare its forward price-to-earnings ratio to the 5-year average before any entry. Open your brokerage app, pull up SU.TO, and compare its current dividend yield against the 5-year average while noting the 50-day moving average price. Before we wrap, keep an eye on whether any hotter August inflation print shifts the stagflation odds further and how that affects energy names on the TSX. That wraps up today's modern investing techniques. Remember, every trade is a learning opportunity, win or lose. Subscribe, share with a friend who wants to invest smarter, and we'll see you tomorrow. And if you'd rather watch than listen, find us on YouTube at NARA Network. Links in the show notes. This show comes to you from the NARA Network. If you want another Shark Daily Briefing, Unintended Consequences has you covered. True stories of good intentions that backfired. All our shows are free at naranetwork.com. The Do Positive Pod is the club for people who do something about it. Episodes and the dispatch wall at naranetwork.com, the DPPOD. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about